Well, howdy there, folks. My name's Thomas, and this is my first video on the channel. So today we're going to be discussing the economic impacts of the New Deal. Particularly, we want to find out if the New Deal helped aid economic recovery or if its overall effects were to, in fact, retard economic growth. The New Deal remains a controversial topic in the United States in economic and political discussions. So some believe that the New Deal actually went about lengthening the Great Depression, while others argue that it was kind of the only thing that helped us recover and ultimately get out of the Depression after World War II. We need to begin by describing what the New Deal was. So the New Deal was a set of domestic economic policies implemented by the Roosevelt administration in order to help aid economic recovery from the Great Depression. Franklin Delano Roosevelt believed that the Depression was caused by excessive competition that reduced prices and wages, and so therefore lowered demand and employment. Thus, the New Deal was aimed at reducing competition and increasing wages. In truth, really, the stock market crash of 1929, along with the collapse of world trade, government policies, bank failures, and panics, and the collapse of the money supply are more reliable explanatory variables than some abstract concept of too much competition. Nevertheless, Roosevelt worked to eliminate the excessive competition that he believed had caused the Depression. So we must now clarify that the New Deal did not, in fact, end the Depression, and many of the most important economic indicators looking at economic health, the US economy, didn't reach their 1929 level until 1941. In a survey of 11 different industries, Taylor et al. Found that employment, output, and hours worked did not reach their 1929 levels until 1939, indicating that the recovery was very weak, if at all, especially when we consider the fact that we need to account for the loss in growth and also the population growth that happened during that time period. For example, the population grew by around 11 million people during the Depression era. We also need to take into account the long-run trend of, say, GDP. When we're looking at the effects of any policy, we need to consider not only returning to the 1929 levels, but also returning to levels when adjusted for growth. If we had continued growing without the Depression, is a better indicator of a full recovery. For example, by 1939, GDP per capita had only reached around 85% of its trend-adjusted growth path. We can therefore conclude that the New Deal did not, in fact, end the Great Depression. But just because it didn't end the Great Depression doesn't mean that it didn't help the economic situation. That's what we need to discuss now. So the New Deal really wasn't a unified and, in many cases, not even a coherent set of policies. It's more of an amalgamation of different programs and administrations put together by the Roosevelt administration. So this reality makes judging the effectiveness of the programs a bit more difficult because they're kind of all over the board. So to better conceptualize the effects of the New Deal, I have two categories, and that includes the largely effective policies, in my opinion, in terms of aiding economic recovery, and those that were ineffective. Beginning with the effective policies, and the first one in that list is leaving the gold standard. So strict adherence to the convertibility of the US dollar to gold preceding and during the Depression led to a serious contraction in the money supply. So when we see a reduction in the money supply, all else being held equal, we will see deflation that will lead to the value of money in relation to the goods and services which you can purchase with it increasing. You can buy more goods with the same amount of dollars. So this causes a lower level of present consumption or the purchase of goods and services in favor of future consumption because, again, consumers can get better deals in the futures. That's kind of the idea since prices are falling. So when consumption decreases, businesses have lower demand for their products. And when there are price rigidities, which basically means that businesses will not lower prices, they'll first try to go about decreasing quantities sold or decreasing their production. That means that we're going to see layoffs And that's exactly what we saw. And so although FDR did abuse his power by seizing gold from innocent civilians to go about doing this, the economic impacts were largely positive because it allowed the government to create a little bit of inflation, which helped most likely to boost current consumption and sort of help get the economy somewhat back on track. So as we can clearly see from gross national product statistics, consumption did increase after the floating of the US dollar. The second good move, in my opinion, on the part of the Roosevelt administration was the reversal of some of the tariffs which were implemented, particularly trying to reverse the effects of the Smoot-Hawley tariff. So the Smoot-Hawley tariff was a poor decision overall, not only because it raised prices to consumers and lowered quantities demanded, but also because it caused other nations to put up trade barriers to American exports or American-made goods going into their countries, which hurt everyone, basically. So the Smoot-Hawley tariff is always, or has been and will continue to be seen as a very poor decision on the part of the US government. FDR's attempts to reverse those policies, those poor policies, was a good decision, in my opinion, from an economics perspective. The third good policy was the creation of the Federal Deposit Insurance Committee. Now this obviously, basically allowed for the ending of bank runs, in many cases bank panics, because it gave consumers, right, that confidence that their money was going to be insured, right, by this corporation created by the government, which then would help add stability to the banking system, and indeed it did. We can see after the creation of the FDIC in 1933, there's a clear uptake in the amount of deposits in the United States. And obviously having a higher level of deposits will increase credit availability and just make business easier for everyone and allow the economy to get back on track. Fourth good policy, I would say, was the creation of public works projects. Now, we've got to remember, of course, Hoover had started that before him, but FDR is really the one that helped to expand that greatly. And in my opinion, those projects made a lot of sense. For example, the Reconstruction Finance Corporation, although signed into law by Hoover, was expanded by Roosevelt, and it gave emergency loans to banks, agriculture, railroads, along with state governments and federal agencies. These loans helped fund the construction of bridges, low-cost housing, sewer systems, highways, college buildings, and other public works. The Civilian Conservation Corps was a program created in 1933 meant to employ young men in the preservation of national parks and just public land in general. They were able to plant over 3 billion trees, protect 20 million acres from soil erosion, and aided the establishment of 800 state parks. And obviously this program helped in terms of providing economic stimulus to people who needed employment. And then finally, the Works Project Administration, created in 1935, put 8.5 million Americans to work in building infrastructure. The accomplishments include 8,000 new or improved parks, 16,000 miles of new water lines, 650,000 miles of new or improved roads, along with serving 1.2 billion school lunches. So generally speaking, infrastructure is a very good investment on the part of the government, considering that there were a large amount of unused labor supply. It makes perfect sense that the government should go about doing these programs, in my opinion. In the long run, infrastructure obviously helps to promote economic growth by improving overall productivity. And infrastructure makes sense for deficit spending as a target of deficit spending because the benefits of that spending are ultimately going to go to future generations. While the current generation is having to build it, but the future generation will get the benefits of having better roads, better water supplies, all those sort of things. So in effect, by deficit spending, you're transferring those payments to future taxpayers. And that's why it would make a lot of sense, because just by the benefits received principle, you'd want to be assigning those costs to the people who are going to receive the benefits. Unfortunately, the New Deal was not in fact perfect. There were a number of policies that had significantly negative impacts on economic recovery, beginning with the PRA, the President's Reemployment Agreement. This was signed into law in 1933 after the enactment of the NIRA, which we'll get into in a few moments. But it was really meant to increase work sharing. Now, work sharing is basically the idea of reducing one's own hours or reducing the hours worked for laborers so that there could be more people employed overall. So the PRA set a 35-hour work week limit, minimum wages, along with the collective bargaining rights to employees. In return, businesses who participated in this would be allowed to display the Blue Eagle emblem on their products as a sign of support and patriotism. So what did incentivizing businesses to raise wages and reduce hours do? Well, in a study that used regression analysis to determine the impacts of different policies on employment, weekly hours worked, wages, prices, and output for 11 different industries, the PRA was associated with lower output, hours worked, and reduced the rate of employment growth that had been achieved during Roosevelt's first 100 days in office, along with increases in real wages. So these outcomes make perfect sense using standard economic theory. Let's say, for example, we were looking at the textile industry. Well, what will happen when you impose a minimum wage? Well, there'll be a higher quantity supplied of labor than there is demand. In other words, there'll be more people that want to work at that wage than there are needed at that particular wage. What this causes is, well, unemployment. And the unemployment occurs as a result of the simple fact that people have different levels of productivity and the value that they can add to the firm will be different. Some people may have a higher level of marginal productivity. In other words, they can add a higher level of value to the firm while others may not. What a minimum wage does is makes it illegal to pay anyone below that point, below that artificially set price floor. And what this can cause, and in some situations does, is people whose marginal product or the value that they add to the company is lower than the minimum wage are unable to find work. And so therefore that will explain why we see a decrease in the rate of employment growth that had been achieved previously. So now we move on to one of the worst offenders, and that is the National Industrial Recovery Act. So the NIRA basically helped to establish codes of fair competition for each industry. These codes were basically the operating rules that all firms in an industry had to follow, and they were negotiated between the businesses and labor unions. The industry had to accept collective bargaining and raise wages before the codes could be approved. In return, the act suspended antitrust laws and in fact encouraged businesses to collude on prices and output levels. Now, the effects of these policies were very widespread, and almost 80% of non-agricultural jobs were covered by the NIRA by 1934. That encompassed over 500 industries. Now, this reality led to cartelization. No, not that type of cartel. It's where companies work together to set prices and output to increase profits. OPEC is the classic example of a cartel. This is the Organization of Petroleum Exporting Countries. Basically, it means that each member nation is going to agree to set their output level at some determined point, and they will only export that amount of oil. This effectively allows them to reduce the supply of oil and increase global oil prices, supposedly to allow each nation to benefit more. So one of the good things, if there are any good things about cartels, is that they're generally very difficult to keep together because, of course, the incentive for each individual is to cheat and take advantage of those artificially higher prices to sell more goods or more products. However, it turns out when members are legally required to be a part of the cartel, like what happened under the NIRA, every business within an industry was required to adopt these codes, and that actually raises the costs of cheating by quite a bit. When we say cheating, we just mean decreasing prices by below whatever arbitrary level the codes had established or the businesses had agreed on. And these policies were undeniably negative, as they reduced supply, increased prices to consumers, and promoted inefficiency. So this graph, for example, displays prices of goods, right, in cartelized versus non-cartelized industries, where anthracite coal was the industry that was not cartelized. Prices remain lower in the non-cartelized industry, while they rise in the cartelized one. Finally, we can see here from this graph that the NIRA was associated with decreased employment. Thankfully, the Supreme Court found the NIRA unconstitutional in 1935. However, unfortunately, the FTC later found that collusion largely continued unprosecuted even after the NIRA was deemed unconstitutional. So what is the overall impact then of the New Deal on economic recovery? So although the New Deal clearly had some effective policies, as we discussed before, in aiding the economy, in the end, they were overshadowed by the cartelization that the government allowed for, along with the imposition of regulations which pushed up wages and employment down. So looking at the big picture, I assembled an index using the aforementioned study where the values are set to 100 in the beginning period and adjusted using the changes in those measures over the different policy regimes, right? The PRA, the NIRA, and a couple of other policies under the New Deal to try and get the overall effect of the New Deal on these really important economic metrics that we want to be looking at. By the way, I excluded numbers that were not statistically significant. Overall, we can see that the New Deal policies were associated with lower levels of employment, hours, and output, along with higher wages and prices. This is, of course, consistent with standard economic thought, and therefore allows us to conclude that the New Deal, in fact, likely did retard economic recovery. And although there were some very effective policies, there were also some very ineffective blunders implemented by the Roosevelt administration that should never have been used. Thank you so much for watching this video. I hope you enjoyed it. If you have any different opinions, please let me know down in the comments section below. God bless, and I hope you guys have a great rest of your day.